95% of traders lose money. You have probably heard that number so often that it starts to lose its impact. But take a moment to really think about it. If the vast majority is losing, it means most people are approaching the market in the exact same way. And that approach is flawed. It is not because they are unintelligent, lazy, or unlucky. The reality is much simpler. They enter a game they do not truly understand, with a mindset that places them at a disadvantage from the very beginning. In this video, we are not focusing on magic indicators or hidden chart patterns. Instead, we will break down why most traders fail, how smart money uses retail behavior as fuel, and what needs to change in your thinking if you want to avoid being part of that 95%. If you enjoy this kind of content, make sure to like the video, subscribe, and turn on notifications so you do not miss what comes next. And let us know in the comments what topics you want us to cover next. You will also find links to our trusted partners in the description. When you use those links, you help support the channel and keep this content moving forward. When most beginner traders look at a chart, they tend to interpret it in the same predictable way. Price breaks above resistance, so it must be a breakout and a buying opportunity. RSI shows oversold conditions, so a reversal must be coming, and they go long. A strong bullish candle closes, and now it feels like confirmation, finally making it seem safe to enter. Everything appears logical, almost like something taken from a textbook, but the market does not reward what feels safe or obvious. In many cases, those clear levels and familiar signals are exactly where larger players are positioning themselves to distribute or accumulate. While retail traders react to breakouts and confirmation candles, professionals are thinking differently. Instead of following the signal, they step back and ask a deeper question. Who is trapped here? And where is the liquidity that can drive the next move? The issue is not the tools themselves, such as support and resistance, RSI, or candlestick patterns. The real problem lies in how these tools are used in practice. Most traders treat them as simple buy or sell signals, like a green light or a red light, instead of understanding them as part of a broader narrative that requires context. They focus on isolated signals without considering how those signals fit within overall market structure and behavior. Because of that, they repeatedly make decisions based on incomplete information. When you think like the majority, you naturally place trades in the same areas as everyone else, following the same logic and reacting to the same triggers. And more often than not, you will be stopped out in the exact same places where the majority gets stopped, because you are operating within a framework that smart money is actively designed to exploit and take advantage of. Price does not move because you are right. Price moves because someone with more capital has found enough orders to execute their position efficiently. Think about a large player who wants to build a significant buy position. They cannot simply enter with a market order, because that would push price up against their own entry and damage their average price. What they need is liquidity, and liquidity is nothing more than the orders of other market participants. These include stop losses, take profits, and breakout entries placed at specific levels on the chart. So where does that liquidity usually sit? Below obvious swing lows, where traders place their stop losses. Above clean equal highs, where breakout traders place buy stops. Around clear indicator signals, where retail traders tend to react in the same way at the same time. When price sweeps those areas and reverses, that is often a liquidity grab, not random movement. If you do not understand this, you are not trading the move, you are fueling it. Even when traders begin to understand market structure and liquidity, many still struggle for one main reason. Their emotions take control of their decisions. Fear of missing out pushes them to enter trades at the very end of a move. Fear itself causes them to close winning trades too early and hold losing trades for too long. After a big win, overconfidence leads them to increase position size unnecessarily. At the same time, doubt can keep them frozen when a valid setup finally appears. Many believe they need a better indicator, but in reality, what they need is a better relationship with uncertainty. The market operates on probabilities, not certainties. No setup works all the time, and losses are not personal failures. They are simply part of the process. The real risk begins when traders react to losses by changing strategies constantly, chasing random opportunities, or trying to recover quickly. Without a clear system and predefined rules, the chart becomes a reflection of your emotions, and the market is extremely efficient at exploiting emotional decisions. Most traders become fixated on the surface of price and what they can immediately see. They zoom in on individual candles and try to assign meaning to each one in isolation. A hammer appears, so it must signal a reversal. An engulfing candle forms, so the trend must be changing. Candles do tell a story, but only when they are viewed within a broader context. A bullish candle forming in the middle of nowhere may have little to no real significance, but that exact same bullish candle appearing right after a sharp stop run below a major low during a high liquidity session can carry a completely different meaning. The difference is not in the candle itself, but in where it forms and what just happened before it. Without that context, you are only seeing shapes. With context, you begin to understand the story behind price. The real questions are not about the name of the candle, but about where and why it is forming within the market. Location and context are what give meaning to any price movement. Where exactly is this candle appearing on the chart? Did price just sweep a significant high or low before forming it? Are traders now caught on the wrong side of the move, creating potential fuel for continuation? Is price moving toward a clearly defined pool of liquidity that could attract the next move? These are the questions that matter. Without this context, you are simply reacting to visual patterns and familiar shapes. But when you add context, you begin to read behavior and intent behind price movements. And that shift completely changes how you interpret every move on the chart, turning confusion into structured understanding. Now let us talk about process. Most losing traders do not truly follow one, even if they believe they do. Their routine is often simple, unstructured, and highly reactive. They open the chart, scroll through price, notice something that looks interesting, and quickly take a trade without a clear plan. After entering, they adjust the stop loss because it feels like the trade needs more room. Then they watch profit and loss fluctuate, reacting emotionally, and eventually close the trade based on fear or greed rather than rules. That is not a structured approach. It is pure reaction. A professional trader operates in a completely different way. Before the market even opens, they already know which markets they will focus on, where the key daily and weekly highs and lows are located, and where liquidity is most likely resting. Their decisions are prepared in advance, not made under pressure. They prepare scenarios in advance, so there is no need to improvise under pressure. If price sweeps the previous day's low during the London session and shows clear rejection, they are ready to look for buying opportunities. If price moves above last week's high and begins to stall, they pay attention to signs that breakout traders may be trapped. By the time they enter a trade, everything is already defined and aligned with their plan. Their entry, stop loss, risk per trade, and target area are all pre-planned before execution. There is no decision-making in the middle of the trade and no moving the stop just this once to avoid discomfort. They are not trying to predict what will happen next. Instead, they focus on executing a clear plan with consistency. Every decision is made before the trade begins, allowing them to act with confidence and discipline when the setup appears. So how do you move from being random and emotional to developing a real edge? Step 1 is to choose a single framework and simplify your approach. Stop jumping from one strategy to another every week, because that prevents you from building real understanding. Instead, select one structured way of reading the market and commit to it over a meaningful sample of trades, whether that is 50 or 100 executions. Clearly define your timeframes, how you identify key highs and lows, and what a valid setup actually means for you. Step 2 is to focus on location, not just signals. Rather than asking if this is a bullish pattern, ask if this is the right place on the chart. Did price just sweep a clear high or low? Is there a visible pool of liquidity nearby? If the location is poor, even the best-looking setup has little value. Next, you must think about risk before profit. You do not control how far a trade will move in your favor, but you do control how much you lose when you are wrong. This means risking a small, consistent percentage of your account on each trade and placing your stop where your idea is clearly invalidated, not where it simply feels comfortable. It also means accepting that a series of small losses is part of staying in the game. Your first real edge is survival. After that comes refinement, and this is where journaling becomes essential. Most traders never review their trades with real intention. They remember the emotional impact, but not the underlying patterns. When you consistently record screenshots, setups, emotions, and outcomes, patterns begin to emerge, allowing you to improve with clarity and purpose. Let us bring everything together. Most traders do not fail because the market is impossible, but because they approach it with the same mindset as everyone else. They chase signals without context and fail to understand how liquidity drives price movement. As a result, they often become the liquidity themselves. Their emotions override their rules, if they even have rules in place, and they focus on candle names instead of market structure. They trade without a defined process, reacting to every movement on the chart. If you want to stop trading like the 95%, you need to think differently. See the market as a search for liquidity, not as a random series of price movements. Focus on location and behavior, not just patterns and indicators. Build a simple and consistent framework, execute it with discipline, and manage risk first. Then use journaling to refine your edge over time and improve your execution. Please also remember that the mission of the ComLucro channel is simple. We focus on giving traders clarity, confidence, and structure, so market decisions are made with discipline and intention. On this channel, you will find complete courses built as a true trading masterclass. We teach market structure, higher time frame trading, and supply and demand, always focused on understanding price behavior and executing with a professional mindset. We also go deep into trading psychology, risk management, and consistency, because trading is not just about charts. It is about mindset, discipline, and structured execution over time. There are no shortcuts. Real progress comes from continuous learning and practice. Our main courses include smart money concepts, technical analysis for day traders, trading psychology, and the Wyckoff method course. Alongside our courses, we share lessons and insights from some of the most respected names in trading, including professionals like David Paul, Alexander Elder, Tom Hugard, Mark Douglas, Al Brooks, and Larry Williams, whose experience has shaped how traders understand markets today. So, if this video helped you gain more clarity, leave a like. It helps this content reach other traders who are on the same journey. Make sure to subscribe and turn on notifications so you don't miss our latest lessons and insights. Now, I would really like to hear from you. Which concept in this video made the biggest difference for you? What topic would you like us to cover next? Leave a comment below and let us know. If you want to go deeper with exclusive content, early access to videos, and additional tools to support your development, consider joining the ComLucro Trader community right here on YouTube. It is a simple way to support the channel and a smart investment in your own growth as a trader. Thanks for watching, and I will see you in the next video.